This is not how a boom announces itself, the genuine kind. Not the kind that requires a press conference or a campaign rally or a headline constructed to confirm what someone already needed to believe. The genuine kind arrives in the data, in the currency, in the compounding relationship between what a market gains and what the unit of measurement used to record that gain is actually worth. It arrives quietly in the comparison that no one in the louder room thought to make. Most people were watching the wrong number. The Dow Jones Industrial Average crossing a new record is a specific kind of event. It is loud. It is photographed. It is cited in speeches. It becomes evidence of a narrative about greatness and momentum and the vindication of a particular set of economic choices. And for the people watching that number in isolation, as a point on a chart, as a headline, as confirmation, it appears to be exactly what it is described as. Growth, prosperity, performance. What it does not show is the denominator. A market index is a ratio. It is a price level expressed in a unit of currency. When that unit of currency is losing value simultaneously with the index rising, the real return, the return measured not in nominal points, but in actual purchasing power, in what the gain can actually acquire in the world, is not what the headline suggests. It is smaller, sometimes much smaller. Sometimes, depending on the rate of currency depreciation and the rate of nominal index appreciation, it is effectively zero. The number went up, the wealth did not follow. This is the structure of what was being called a boom. The dollar's decline during the same period that American equity markets were posting record nominal highs is not a footnote. It is the context without which the headline has no meaning. An investor who held American equities through that period and measured their return in dollars saw the number the news was reporting. An investor who measured their return in any other major currency or in the purchasing power of the goods and services those returns were eventually meant to buy saw something different. They saw the boom and its shadow simultaneously. The shadow was large. This is where leverage quietly changes hands. The Toronto Stock Exchange did not generate the headlines that American markets did during this period. It did not produce the kind of coverage that turns index performance into national mythology. What it produced was returns, measured in Canadian dollars that were, during the same window, appreciating against the American dollar. This combination, equity appreciation plus currency strength, produces a compound effect that is mathematically straightforward and rhetorically almost never discussed. When your market goes up and your currency goes up, the real return is both. When your market goes up and your currency goes down, those two movements are working against each other, and the net result is the number that does not appear in the victory speech. The TSX's composition tells the story of why this divergence occurred and why it was not accidental. Energy, mining, banking, natural resources. These are not glamorous sectors. They do not generate the kind of cultural excitement that surrounds technology companies whose valuations are built on projected futures rather than current cash flows. They do not produce billionaires who become cultural figures. They do not trend. What they produce is revenue tied to physical reality, revenue tied to the price of oil that is actually extracted and actually sold, revenue tied to minerals that are actually processed and actually delivered, revenue tied to loans that are actually made and actually repaid under regulatory frameworks that did not permit the kind of exposure that periodically detonates American financial institutions. Physical reality is not glamorous. It is also not a narrative. It simply is. And in periods when the distance between narrative and physical reality becomes large enough, the adjustment is not gentle. The American technology sector's dominance in equity market capitalization is a structural feature that shaped the trajectory of American index performance during this period. A small number of companies, sufficiently large in market capitalization to move index levels in ways that individual sector performance in a more diversified market cannot, carried a disproportionate weight in the numbers being cited as evidence of broad economic health. When those companies performed well, the headline numbers performed well. When those companies were priced not on current earnings but on scenarios that required a specific and optimistic version of the future to materialize, the headline numbers reflected that optimism. Optimism is not a balance sheet entry. It is a sentiment that changes. The Canadian banking sector's performance during this same period reflects something that is structurally different from the American financial sector's behavior in comparable conditions. Canadian banks operate under regulatory constraints that were tightened after the 2008 crisis and that were not subsequently relaxed under pressure from the institutions being regulated. The result is a banking system that generates lower peak returns in the most euphoric phases of an economic cycle and significantly lower catastrophic losses in the corrective phases. It is a system optimized for survival and stability rather than for the production of spectacular quarterly results. Stability, compounded over time, is not a consolation prize. It is a strategy. And it is a strategy that produces a specific kind of balance sheet outcome. Not the vertical ascent of a technology company during its most speculative phase, but the steady accumulation that continues to function when the vertical ascent reverses. The tariff architecture that the Trump administration constructed did not operate in isolation from the inflationary pressures that American consumers and American businesses were experiencing during this period. Steel and aluminum tariffs imposed on imported materials are not absorbed by the exporting country. They are absorbed by the American manufacturers who use those materials as inputs. Those manufacturers do not absorb the cost. They pass it forward. The price increase travels through the production chain and arrives at the end as a consumer price. It arrives as a cost of living increase in the same communities that were being told they were living through a boom. This is not theoretical. It appeared in the data. It appeared in the inflation figures that American households experienced while the index was posting records. The number on the screen was going up. The purchasing power of the wage was not keeping pace. The gap between the nominal performance being celebrated and the material experience of ordinary economic life was not a statistical artifact. It was the actual condition of the economy beneath the headline. Canada's inflation trajectory during this same period, while not immune to global price pressures, reflected the relative insulation that comes from not having initiated a tariff structure that increased domestic input costs simultaneously, with the pressures already arriving from global supply chain disruption. The Canadian consumer was not perfectly protected. No consumer in a globally integrated economy is, but the Canadian consumer was not additionally burdened by a policy architecture designed in Washington that made the imports required for domestic production more expensive and then presented the resulting price increases as evidence of the strength of the economy that was bearing them. There is a specific kind of economic confusion that results from measuring outcomes with the instrument that is itself the subject of the problem. If the unit of value is depreciating and the instrument used to measure performance is denominated in that unit, the measurement will consistently overstate the real outcome. This is not fraud. It is a structural feature of how financial reporting works when currency stability is assumed rather than verified. American financial media operates in dollars. American equity indices are denominated in dollars. American economic commentary is almost entirely conducted in the currency that was simultaneously declining in value relative to the currencies of the countries being described as falling behind. The Canadian dollar's appreciation during this period is not separable from the Canadian economic story. It is the Canadian economic story. A currency that strengthens while its equity markets are rising is a currency that reflects confidence. Not confidence in a narrative, but confidence expressed through the actual allocation of capital by the actual participants in global currency markets. Those participants are not sentimental. They do not strengthen a currency because they prefer its country's political arrangements. They strengthen a currency because the underlying economic fundamentals support that direction. Canadian fundamentals during this period supported that direction. Energy exports generating revenue in a high price environment. Critical mineral positioning that global markets were beginning to price as strategically significant. A banking system that had not acquired the kind of hidden exposure that requires emergency intervention to prevent systemic failure. A fiscal position that, while not without its own pressures, was being managed with a kind of institutional discipline that international capital allocation tends to reward. This is not a crisis. It is a reordering. The social architecture that underpins Canadian economic performance is not incidental to that performance. It is structural. A population that is not burdened by catastrophic medical debt maintains consumption capacity that a population managing health-related financial distress cannot sustain. A workforce protected by a social safety net that does not disappear entirely with a job loss maintains the kind of economic participation that aggregate demand requires. These are not ideological arguments. They are demand-side arithmetic. The consumption capacity of a population is a function of its financial security, and the institutional architecture that produces financial security, or fails to, appears in the economic data, whether or not it appears in the political conversation. American economic commentary tends to treat the absence of these institutional structures as a feature of the system, rather than a vulnerability. The argument is that the dynamism produced by individual exposure to risk, the necessity of performance without a safety net, generates innovation and productivity that more protected systems cannot match. This argument has empirical content in specific domains and specific periods. What it does not address is the system-level cost of the instability it produces. The medical bankruptcy, the consumption collapse and downturns, the human capital loss embedded in populations that cannot afford the health and education investments that productivity growth requires. Canada's comparative position reflects, in part, the compounding advantage of not bearing those system-level costs over time. The TSX does not outperform the American market every year. The Canadian dollar does not always strengthen against the American dollar. The comparison over any single short-term period will reflect conditions specific to that period. But the structural features of an economy, the regulatory architecture, the institutional design, the social infrastructure, are not short-term phenomena. They compound, And the compounding over the period in question produced outcomes that the headline comparison of index levels, denominated in a depreciating currency, entirely concealed. Most people did not make that comparison. They were watching the number that was being shown to them. They were watching the record. They were being told that the record meant what records usually mean, that things were better, that the direction was right, that the system was working. The system was working, but not in the direction that headline suggested. And the country that was outperforming it, measured in the terms that actually matter, real returns, currency adjusted, grounded in physical assets and institutional stability, was not the country holding the press conference about the boom. By the time the currency-adjusted comparison becomes standard commentary, the returns will already have been earned. The capital will already have been allocated. The institutional advantages will already have compounded in another year. History does not wait for the louder room to finish speaking before it records what actually happened.